on to our last technical session. In this session, let us understand Ind AS impact on media and entertainment industry, including practical aspects. To share knowledge in this, we have two eminent speakers from KPMG, CA Amrish Raj Chaudhary and CA Santanu Sonde. May request I am Sikasa branch Sikasa chairman to escort the speaker onto the desk and also welcome them with the floor bouquet. Ladies and gentlemen, please welcome the speaker. Very much. Thank you very much. Friends, it's my pleasure to introduce the speakers to this August gathering. CA Amrish Chaudhary, partner, CFO Advisory Service of KPMG. Amrish has over 16 years of experience in auditing and advisory. Amrish is the engagement partner for the assignments. Amrish had led several complex assignments including audits, IFRS conversion, US GAAP, accounting advisory, IFRS US GAAP trainings. Amrish has been working across diverse industries including manufacturing, e-commerce, IT, ITES, energy and natural resources, engineering, real estate, healthcare and consumer goods. Amrish also executes the knowledge management services within the firm on IFRS and US GAAP. Amrish is a regular speaker at internal and external forums. With this brief introduction, I present CA Amrish Chaudhary before you. Please welcome him once again. We have another speaker, CA Santanu Sonde. Santanu is Associate Director with the Accounting Advisory Services Practice of KPMG in Bangalore. Santanu has over 7 years of experience working on advisory projects, providing accounting advice to corporate all issues related to accounting and GAAP, primarily in IFRS, UK GAAP, Indian GAAP and US GAAP. Santanu was seconded to the KPMG UK practice where he spent 5 years working on accounting advisory projects in UK. Prior to working in advisory, Santanu worked in audit for 3 years, focusing on the audit of SEC clients under US GAAP and IFRS in the IT sector. Santanu has worked with clients in a number of different sectors with focus on information retail, technology, renewable energy and supply chain management. With this brief introduction, I present Santanu Sonde before you. Please welcome once again. Thank you.
So thank you, sir. Thank you for the kind words and the introduction. And good evening, friends. I think what is important is under Ind AS we have all learned how the governance structure in India is changing, how the regulatory requirements are changing, and to align with the global requirement, the regulatory authorities also wanted to align the accounting reporting aligned to the global requirements, which is IFRS or the US GAAP, predominant gaps globally. And what we did is that why we don't call it IFRS in that sense or US GAAP for that perspective is that because we made certain exceptions to those IFRS regulatory requirements, and those are the converged standards. I'm sure you have attended enough of sessions why we call it Ind AS and what's converged standards. I'm not going to dwell upon that. I think coming back to the topic, I think from morning my fellow speakers would have spoken about different media industry, what it contains. And so I'm not going to dwell upon that. The only thing which is important here is that it's continuously evolving, right from the Doordarshan days to the channels which we saw, to Vivid Bharati or Binaka, Geet Mala or all those accounts, All India Radio, FM radios. I think we have all witnessed those changes in the media and entertainment industry, and the latest trend being right from Netflix to Hotstars of the world. So it's all been evolving. And so are the challenges on the accounting front and the revenue recognition to delays to new standards or new pronouncements which are upcoming. We'll touch upon some of them in our session. In case you have any further queries or doubts, please feel free to reach out to us in that case. But we are keeping it very brief, we are keeping it very practical to the scenarios which are actually present there in the industry today. So I'm sure people, we know, from morning we know what media and entertainment industry. I'm not going to change that. What is changing is the network of the 4Gs and 3Gs reach to the tier 2 and tier 3 cities, and so is the entertainment in the hands of the mobile set right from your TV set now. I think we've discussed this enough on the Ind AS roadmap. When it started, what was the journey of Ind AS? So again, there's a slide more informative. We know about it. Finally, what was made applicable is that there were certain thresholds provided by the regulatory authorities, which were either you are listed and your net worth is more than 500 crores. They all fall under phase 1. In entities which had less than 500 crores but more than 250 crores, and listed entities subsequently were fall under phase 2. Both the phases are over. Now only thing which you can face now is that any company which becomes either crossing that threshold of 250 crores or by way of acquisition of some other schemes becomes subsidiary of any entity which is currently following the Ind AS. So if you are a subsidiary or an associate or a joint venture for that matter, you will have to mandatorily follow Ind AS. How does this apply? Say for example, any financial year, in your case if the company meets the threshold on 31st of March 2019, it becomes applicable from the next year, that is 31st March 2020. It's the first year when you go back and report Ind AS, and you can put that example in any context at any point of time in future. So what happens? Once, in our example, if say 31st March 2019 is when I meet the threshold, that means 31st March 2020 is when I do the first reporting. My opening balance sheet becomes 31st March 2019. Right? And the first transition rate becomes 1st April. Right? And I'm sure you have gone through this in India, so that's all which you have dealt with. So moving on, what are the key Ind AS impacts which you are talking about? Anything from your experience you believe there is an Ind AS implication on media industry before you get into the details? You have dealt with any of the Ind AS adjustments? Anything that crosses your mind? So what we did is that to keep it more practical, we took out some of the balance sheets of some of the companies' financial statements which are publicly available, either on their websites because they are listed entities or on the ROC website, and we took and analyzed what kind of impacts they have reported under Ind AS. Right? So you know, under Ind AS, once you have to change from an Indian GAAP to Ind AS, you need to provide two reconciliation. One is the equity reconciliation and one is the profit reconciliation. How numbers have changed from your earlier reported GAAP numbers to your Ind AS numbers, right? And the detailed reconciliation is what you need to disclose in your notes to accounts. We have picked up your profit reconciliation as a basis. Almost it's the same, right? So in case if you see about Eros International or Balaji Televisions, you will see in some cases the profit has actually gone down because of Ind AS adjustments, and in some cases the profit has moved northwards due to Ind AS adjustments. Now, which is the right example? It depends on the situation, it depends on the transition options which you have taken, it depends on the accounting policy choices which you have taken under Ind AS or what you have taken in your erstwhile GAAP. That can change the direction of your profit. It can be either neutral, it can go upward or downward. It's not necessary that once you implement Ind AS, it will always go southwards. Right? Because many people come and tell me that expected credit loss has reduced my profit, effective interest rate is reducing my profit, and so on and so forth. There is no one remedy for all of them. It all depends on what policies you adopted earlier and what are the impacts that you are getting specifically because of transition options of Ind AS, and finally implications of the deterioration. Some of the key topics which were there is, say for example, fair value of share-based payments. This is generally the case with most of the MNC companies. Now you see with lot of startups now, right? It was not a trend when they were typical manufacturing or promoter-driven companies from an Indian promoter group to share the wealth in form of equity with the employee. It was primarily in the form of either remuneration and bonuses. But the trends are changing. Today the startups offers you a lot of other incentives in form of participating in the wealth creation. And how that is differentiated in Ind AS versus Indian GAAP or the erstwhile GAAP is that it was always followed on the intrinsic value, now it goes into the fair value. Right? So that makes a change in your knowledge in your P&L. Similarly, expected credit loss. I think this model has been one of the most debated models. Because in the erstwhile GAAP, we were used to make provisions for our receivables in case they have not been received for a number of days. Right? We used to bucket it. More than 90 days, we used to say, okay, 25%. More than 180 days, we used to say 50%. There was no literature supporting. is no guidance saying that okay, if it is more than 180, you need to provide 50% or you need to provide 100%. It was a matter of judgment. It was the practical experience. It was the industry trend and particular to that company also. Right? What it says now is that rather than what has happened in the past or on the age basis, it says develop a methodology which will tell you expected credit loss. So that means based on a historical trend, based on the relationship with the client, based on other facts of the economy, you see what can be the provision on day one, and don't wait for that expiry of 90 days or 180 days or 360 days. And there is a detailed model which works on this to ensure that what you provide in the books is the most expected loss which you may end up incurring when you realize that receivable. Right? And obviously this undergoes estimation change on reporting date. It is not that once I have provided it will always be the same number. You need to deploy that model at regular or periodic intervals as and when you are reporting it. But in most of the cases, this has led to reduction of profit, because what you are doing is that you are preponing the provision from a future day to today. Something which you would have provided after 180 days or 360 days, if that expectation is that I will end up losing some money there, you need to provide for it on day one. Not wait for the event to happen or not wait for that period to get over based on my policies. So that was one adjustment. I think adjustment due to business combinations were very rare in some of the Indian scenarios. What it says basically is that when you acquire a company, right, and there are two concepts there. One is a common control transaction and one is a genuine business consolidation. There was no differentiation given under Indian GAAP for both the scenarios. Right? The Ind AS has got a lot of changes for that, and what it says is that under business combination, if once it meets the definition of business, you need to do a PP allocation, and in that, apart from book value of assets which you have acquired, you can also identify additional assets there, both tangible and intangible to that extent. Right? You can say, for example, if the company is into a networking company, if the company has a customer base, if the company has a technology, which was in-house developed technology, but it never got capitalized threshold, now you can recognize that as intangible. That brand which you are acquiring can be treated as intangible, and you can allocate a value to it. Right? And in this case, whatever goodwill is recognized as a balancing number after whatever amount you have paid and the assets you have acquired, that's tested for impairment. I think I'll go straight away to fair value of plan assets, reversal of straight lining. I think this is very common. This is not restricted to media and entertainment. Reversal of straight lining, if you recall in the earlier period, if you have leases and if you have inflationary clause, you used to straight line your rent. Right? Say for example, if you have a 3-year lease and year one rent is 1200 rupees and next year onwards it is 10% increment, then you used to say, okay, effectively for the period of 3 years, I'll pay somewhere around 4,200. 4,200 divided by 3, somewhere around that 1,300, 1,400 number is what you used to provide. Whereas the actual liability for year one was only 1,200. And the Ind AS, what it said is that if 10% is in line with inflation, you don't need to straight line it. Now what is inflation and what is in line with inflation is again to some extent matter of judgment, but you need to use it with your professional competency and again your experience with the client. But what it says is that if it is in line with the inflation, you don't need to do straight line. So a lot of companies remove that straight lining impact, and obviously the rent for that period, depending on which period of lease period you are, that got impacted either moving upward or downward. Right? I think this one is a common one. When you have actual gains or losses, they used to route it through employee cost. Now it is routed through OCI. Right? OCI is nothing but a second part of P&L. Right? Your P&L has two parts now. So I'm not getting into details of that again because I'm sure you have dealt with it enough. You have done enough of Ind AS conversion. I think borrowing cost was another which gets captured into effective interest rate. What it says basically is that, say for example, you are taking a bank loan and for that you are paying an upfront fee for the legal charges of 2% of the loan. In the erstwhile GAAP, you used to charge it off on day one as the expenditure. Now what the literature says is that factor this in your effective interest, and what it does is that the 2% gets spread over the period of the loan. It doesn't get recognized on day one. So obviously that will help me in improving my profit on day one. The other one which was very common is the declaration of dividend. Dividends were typically the year-end dividend, the annual dividend. Right? What it used to do is that your board meeting used to recommend an annual dividend, and post the year-end, your shareholders used to approve it. However, because the literature or the guidance required you to make that provision on the 31st March financial statement, you need to make that provision. What Ind AS said is that it will not be in the year in which it gets declared. It is when it gets approved. So, for example, if the year-end dividend for 31st March 2019 was approved by the shareholder in AGM, it will not be recorded on 31st of March 19. It will be recorded post 31st of March, and if you are doing a quarterly reporting depending on that, otherwise annual financials of 31st March 2020 will have that provision. And all these impacts were also led to the deferred tax impact on the respective adjustments. So whatever adjustments you did, whether it is increasing your expenditure, reducing your expenditure, it also led to a deferred tax impact on that. And that's how we concluded on the reconciliation of the profit under the erstwhile GAAP and the Ind AS when they finally adopted it. I think we spoke about expected credit loss. This is more a theoretical definition. So because I've spoken, any questions so far? We spoke about transaction cost. We spoke about expected interest rate. Security deposits, right? I think I have not touched upon that. Security deposit, again, this is typical what you do, pay security deposit for your lease premises or any other reason to government also. What it says is that you need to create a present value for that, right? And that financing cost comes into picture. Component accounting is again something which is specific, not to, I don't think it is so prevalent in the media industry, more in the manufacturing setup where you have those large capital assets which requires a different kind of accounting than the simple spare part accounting, provided it meets those thresholds. One more thing which is important under the Ind AS is that earlier we used to have anything which was an error in the past, we used to disclose that as a prior period adjustments. Right? There was one line item which used to say prior period adjustment. Under Ind AS there is no concept of any international GAAP, there is no concept of prior period adjustment. If it is not material, you disclose it. If it is material, and materiality again is a matter of fact and judgment. If it is material, then you don't have a choice but to go back and restate your previous year reported numbers. Right, which normally is not a very great sign because that clearly depicts that there were errors, and those errors are not appreciated by the regulator. Under Indian scenario, we can think of only one company so far, Satyam, because it was a SEC listed client and they used to do US GAAP reporting. When the fraud happened, they had no choice but to go back and restate the earlier year numbers. I think with that, what I would request my friend Shantanu to talk about the new revenue standards which have got significant implications on media and entertainment industry, and not only media and entertainment industry, across several technology companies, across all the sectors which at least we have dealt with. Right? And it clearly changes the way we used to recognize revenue, it clearly changes the way we used to interpret the agreement. And I think I'll request Shantanu to take over and take us through it one by one. Thank you.
Yeah. So before I start on Ind AS 115, I just wanted to understand: has anybody dealt with Ind AS 115 or IFRS 15, which is the equivalent standard under IFRS? If not, I'll just give you a brief background of where this has come from. So there is a new standard even under IFRS called IFRS 15, okay, which is a new revenue recognition standard which is applicable from the current year. So for financial year statements beginning after January 1st, 2018. That is internationally. And an equivalent standard has also been issued under Ind AS called Ind AS 115, which is applicable for financial years beginning after 1st April 2018, because India works on the April to March financial year. So it is applicable for financial years beginning after 1st April 2018. So this year, as we are speaking, will be the first year of application of this new revenue recognition standard. Okay. So before the standard came in, what was the previous standard which is there? It was a standard called Ind AS 18. So there was a standard which already existed for revenue recognition. This is a new standard which has come up. Why did they issue the standard when there was a perfectly good standard for revenue recognition that already existed? The reason was the earlier standard that was there, what had happened over many years was that each sector effectively had developed their own principles and rules in terms of how the standard was going to be applied. Okay? And what Ind AS 115 does is again bring this back into a common set of rules and regulations which would be applicable for every sector, every company. Okay? So this is what the standard is doing. So there is a single model of revenue recognition which will be applicable for every company going forward under this standard. And what is the big change that has occurred from Ind AS 18 to Ind AS 115? Under Ind AS 18, and I'm sure it was there under AS 9, which is the Indian GAAP revenue recognition standard, right? What did AS 9 say? When did you recognize revenue typically? When was revenue recognized?
When it is due.
When it is due, but there was a specific point at which revenue would be recognized. So, sorry? Yeah, so there was a concept of transfer of risk and rewards. So what the earlier standard said was whenever there is a transfer of risk and reward is when you recognize revenue under Ind AS 18. Okay. What Ind AS 115 says is you recognize revenue when there is a transfer of control, not when there is a transfer of risk and reward. So there is a subtle difference in the point at which revenue is recognized, and as we go through some of this you will understand where that is coming from. But just remember that this shift from a risk and reward approach to a control approach is something that IFRS is consistently bringing in across all standards, and because we have effectively adopted IFRS through Ind AS, it will also be applicable to us. So we will discuss something else after the revenue standard, which is the new standard which is coming in for leases, where again you will see a shift from a risk and reward model to a control model. Okay, so just remember that. In terms of some of the effective dates of when the standard came in, so I don't know if some of you remember when the first batch of Ind ASs were notified. I think this was in October 2015. In Feb 2015, when the first batch of Ind AS was notified. They had notified this standard, Ind AS 115. Subsequently, in October 2015, they withdrew the notification and they notified the earlier standard that was there under IFRS, which was effectively Ind AS 18. The reason for that was, if this had gone through, what would have happened is India, being a first-time adopter of Ind AS and effectively IFRS, would also have been the first time, we would have led the world effectively in the adoption of the new revenue recognition standard as well. So without understanding what everybody else is doing across the world, we would have been in a position where we are basically adopting the standard which the regulators did not want. So they went ahead and notified the old standard, which was Ind AS 18, and the new standard, which is Ind AS 115, as I said, will be applicable from April 1st, 2018, and the notification for that application came only on March 29th of this year. So basically 2 days before the standard was going to be effective, the government notified that the new standard will be effective from April 1st, 2018. Okay. So what is the overview of the standard? I said there is a single revenue recognition model that exists now for all revenue that is going to be recognized going forward. So what is that single model? The single model is simply that there is going to be 5 steps of revenue recognition, and every piece of revenue that you recognize will have to go through this 5 steps. What are the 5 steps? First is identify a contract with the customer, identify performance obligations that exist in the contract. Performance obligations are nothing but what are the various things that you have promised to the customer. Okay? So you may have promised only one thing, in which case there is only one performance obligation. But let's take the case of say a laptop with an extended warranty. Okay? So there you are promising 2 things to the customer. You are promising a laptop, and you are also promising that the laptop will function for a 3-year period or 4-year period, whatever the extended warranty. So you have to identify what are all the promises that you made to the customer. Third is determine the transaction price. So you determine what is the total consideration that you're going to get from the customer for that contract. Fourth is you allocate that price then to the various promises that you identified in the second step. And fifth is you finally recognize revenue. So you go through this 5-step model irrespective of the sector that you are in, irrespective of the kind of customer that you are dealing with. And ultimately you will get to revenue recognition under the new standard. Okay. In the media and entertainment sector, what are some of the key issues that we see in the application of these steps? So first of all, let's take the case where you are a movie producer, okay, who has a copyright, and we discussed copyrights this in the previous session, who has basically owns a copyright for a film, okay, surely. And in that scenario, you want to kind of license this copyright out to say Z Telefilms or ZTV for them to broadcast it for over a 5-year period. You want that license, time-bound license for 5 years. After 5 years, the copyright will revert back to you, and then you can give it to Sony or you can give it to another channel. Okay. So, and you get some upfront consideration. So when you license this out, you get some upfront consideration. Say you get 1 crore, okay, for a 5-year license of this movie. So under Ind AS 18, under the previous standard, how do you think revenue would have been recognized in this case? So you get 1 crore and there is a license for 5 years. So under Ind AS 18, typically what you would have done, right, you would have mostly straight lined that revenue over the 5-year period. So every year you would have recognized 20 lakh rupees. Okay. What Ind AS 115 says, because again it comes back to the risk and reward, because you said that the reward that the customer is getting is spread over a 5-year period, and therefore I will recognize revenue over the 5-year period. Okay. What do you think will happen under Ind AS 115? I gave you a brief that we've moved from a risk and reward model to a control model. Sorry? You immediately recognize the revenue. The reason for that is, effectively, when that first transaction happened, your promise, you have delivered on your promise. Okay? You have delivered, you have given the copyright, you have licensed the copyright out. You do not have any further obligations in respect of that movie. That movie has already been made. You don't have to incur any further cost. You don't have to do anything else for over a 5-year period. The 5-year period is only the time-bound license, but that does not result in any additional performance obligation for you. Okay? In that case, the only performance obligation was the delivery of the license on day 1 that you met. As soon as you met that, you recognize the full revenue upfront. Okay, so this is a significant area of change. If you, yeah.
But the corresponding cost adjustments are required.
No cost adjustments are
What I
required.
mean is that the revenue is recognized in year 1 and the costs are coming over 5 years, I suppose.
So, no, I'm saying that there are no costs, right? You already made the movie.
True, means the normal recurrent costs which are there,
Yeah.
which would have otherwise accrued over 5 years.
So
not directly ascribable to this
correct.
will continue in its own way.
Will continue its own. Yeah.
So if there is no business in the next 4 years, the next 4 years will be loss.
Okay. So if this was your only source of revenue, then effectively your P&L is now completely distorted.
No, it's not distorted because it's what it's supposed to be.
Distorted compared to what you earlier had. So that is one example of a change. Another example, not really a change, but where the standard clarifies it in much more detail, is say again you're a Netflix who's got who has acquired a show, okay, some show that you created, and you've run it on Netflix. Now you want it to be available for people through television as well. Okay, so again you go to a Sony or a Z and say, why don't you broadcast my show? Whatever ad revenues you get from that, you give me some share of that ad revenue, because I don't know how the show will perform and they don't want to put up any money upfront. So they give you a share of profit. So even in this case, actually, the performance obligation by itself is satisfied on day one, right? I mean, it's the same as the previous example. The only difference is that in the first case that we discussed, there was no contingency to the revenue that you were going to get, because that was fixed on day one. In the second situation, it depends on the amount of ad revenues that are generated every period, and you get a share of it. So what the standard clarifies is where the revenue is variable because it is linked to a sale target or usage. Even though technically you should still be estimating and recognizing revenue on day one, it says that only in those cases you do not do that. What you do is you wait for the contingency to resolve. So every period you know how much of ad revenues were generated on Sony or Zero, whichever channel it was broadcast on. And whatever your share of that revenue is, you take it in those periods rather than doing all of the estimations upfront and recognizing revenue upfront. So the difference I just want to point out between the two cases was that in the first case, you recognized it upfront because of two things. One, there was no further performance obligation, and two, there was no contingency in terms of the amount of revenue that you were going to recognize. The difference in second case is, although there is no performance obligation, because there is a contingent revenue which is linked to the sales that is going to happen as a result of the usage of that license, you will not recognize revenue until that contingency is resolved. So until you actually get that share of your ad revenues.
In the first stage, what will you recognize? As soon as you have passed the
nothing. In which case?
In the second example.
In the second case, yeah.
Second example. Suppose 100 rupees is the amount which is being given to you, correct? You are getting or you are giving 100 rupees.
Yeah, so I have created the content, I am giving it to you.
And then it is contingent upon what?
It is contingent upon the amount of ad revenues that you generate using that content. So you will broadcast it to the television.
I can't recognize as and when the ad revenue is generated. I should do that.
You should do that. You cannot recognize it upfront. In the first case, we said, I create the content, I give it to you, I get a fixed sum of money, I recognize it upfront. Second case, I create the content, I give it to you, it is linked to an ad revenue, I will have to wait until the ad revenue is generated for me to recognize it.
And even in upfront, you don't know what is the revenue that is.
Correct. You don't know. I mean, there could have been a case made that you estimated and all that, but they have said no. They said you don't do any of the estimations, you wait for the contingency to resolve before you recognize it.
AS 18, what is the difference? There is no difference.
There is no difference. It is just that there is a further clarification.
As far as the second one is concerned, it is the same.
It is similar to what Ind AS 18. Although there was no guidance, it was effectively practice that was developed over a period of time, which was similar to what has now been defined under 115.
In case of extended warranty, what is the difference between 115 and 18?
So, AS 18 again, so if I just step back, under Ind AS 18 there was a concept of multiple elements in a contract. It talked about multiple elements, and it was never really clear what multiple elements meant. although it was intended to be promises, which we discussed, it was never clear. So what people used to, there used to be mixed practices for warranty under Ind AS 18. So some people used to record a cost provision, and some people used to do a revenue deferral. The technically correct answer under Ind AS 18 was also revenue deferral, but you could follow both practices depending on what that sector or industry followed. Whereas under Ind AS 115, there is specific guidance on warranty, which says warranty is basically of two types. One is an assurance warranty, which is you sell a laptop, you say that the laptop will function as it is intended for whatever is the standard warranty that is given. And an assurance warranty is always a cost provision. So you make a cost provision. A service warranty, so this laptop is intended to function for 6 months, but actually I am also selling an extended warranty to you, or in a car example, I am selling an extended warranty to you, that it will, beyond 6 months, it will function for 3 years. So that is a service that I am actually giving you. So it makes a distinction between the two. Assurance warranty is a cost provision, service warranty is a revenue deferral. Okay. One of the other common themes that comes out in the media sector, especially in the advertising space, is barter transactions. So what happens is you have, say, a 10-second ad spot on Setmax, which is broadcasting a cricket match. Okay? But your client actually wants to telecast an advertisement on a channel which is broadcasting a soap, a daily soap, because it is more intended for that kind of viewers rather than on a cricket match. And some other advertising agency has got a same 10-second ad spot on a soap, on a daily soap. Okay, so you exchange your ad spots. Okay, so I give up my 10-second ad spot that is there on the cricket match to get a 10-second ad spot on a daily soap, and assuming the values of the two are the same. So under Ind AS 18, there was specific guidance on barter transactions, which said when there is a barter transaction, effectively you would have to recognize revenue and cost for this. So you ended up crossing up your P&L because you're getting an ad spot, you're giving up an ad spot. So you cross up your P&L for both the revenue and the cost relating to this transaction. Under Ind AS 115, there is no guidance on barter transactions, but there is guidance on something called non-cash consideration. So in this case, so typically if I have an ad spot, I will sell that ad spot and get some consideration for it, right? If somebody uses that ad spot that I have, I will get some consideration for it. But here it is non-cash consideration, because I am not getting consideration in the form of cash. I am getting consideration in the form of another ad spot, another similar item on a different channel, maybe with a different, on a different program. So in that scenario, what this Ind AS 115 says is, if the product that I am giving, okay, if the product that I am giving and the product that I am receiving are more or less of a similar nature, then I cannot apply the guidance of non-cash consideration, which means that I essentially ignore the transaction. Okay, I don't end up crossing up my P&Ls, showing revenue and cost. I basically say I've given up one ad spot for another ad spot, but essentially both are similar items, and therefore there is no accounting impact of that transaction. So again, it's relevant for people who are in the advertising sector, because it happens very frequently. Now, the few sectors where there is real barter transaction happening.
If there had been no such transaction, how would that portion have been recognized?
No such transaction is
No such barter. Let us say if it didn't happen, then how would that have been recognized?
So that would have been recognized when the ad played on that network. So at the point that the ad played,
so same thing continues to happen.
Same thing continues. Under Ind AS 18, what happened was there were two times you would recognize revenue. One for the barter and second for the actual ad being played. So these are some of the impacts that we've seen in the media and entertainment sector. If you have any other situations, and not just this sector but any others that you want to bounce off of me, more than happy to.
Is it correct to say in a normal sale of goods transaction nothing has changed?
What has changed is, so in a sale of goods, the movement from a risk and reward model to control model has meant some change as a result of, because typically what used to happen is, say in a CIF transaction, when you recognize revenue in a CIF transaction, you recognize revenue, or in an FOB transaction actually, you recognize revenue when the goods move out of your warehouse, because effectively once you hand it over to the carrier of the customer, you say the risk and, because the carrier belongs to the customer, the risk and reward belongs to the customer. In most cases, it could be that you provide that logistics facility also. So you are not just, although you are then acting, you would say that you are acting as the agent of the customer for the logistics facility, and therefore once I hand it over to that logistics agent, although it is me, I will recognize revenue. Whereas in the case of Ind AS 115, there is some debate that is happening which says that if I am producing the goods and I am the carrier of those goods as well, I am not transferring the control of the goods until the goods reaches the customer. So there could be some differences in a sale of goods scenario in terms of the timing of revenue recognition. It could push it out by a few days, which is a cut-off issue. But you are right.
No, in principle, I mean, but then
In principle,
would it not be a legal problem? In the sense, in principle, risk continues to have been passed out.
correct.
So legally there is no claim of the receiving party. If there is a problem after dispatch, then the party receiving cannot claim anything other than the cost of that transfer.
So which is why there is this debate ongoing. I mean, so it happens.
Other contracts, any changes there in the,
So there
the
are.
normal construction contracts type of things?
So typically think about a scenario, say for example, which you are talking also on a ICCS, right? ICCS are when the waters are not into Indian territory and you have, but just by transfer of documents you make those sales, right? So what happens is that there can be three scenarios built up in the control environment. Control can preside the revenue risk and rewards, a legal risk and reward which you are talking, because I have got that document, I can ask them to instruct.
No, I don't have a claim back on that. Once I have transferred the document, I am no longer having a claim on that.
So that's what I'm saying. Your control can either be preceding the legal transfer of the document, can coincide with your legal transfer of the document, and can be post that also. Right? Say for example, this property of premises, I have given you a control to use it in the way you want to use it, effectively, right? But the legal right is still with me. You may still end up in a situation that this property has been sold to X. You may not have transferred the legal right. Or you may have transferred the legal right to the fact that the registry of this property will happen after 1 year, but you have got all the rights to use it and the way you want to use it. Or to liquidate it or to sublease it, like a owner, right? So in this case, your control is preceding the legal risk and transfer. You can still coincide with the fact because you can recognize the revenue on day one, rather than waiting for that legal transfer to happen. And the other example in the media industry which we have seen, at least and it is in the public domain, is like something like Amazon Prime. You know, Amazon Prime, if you have to take Amazon Prime, you end up paying that 999 rupees or 499, whatever the scheme. And against Amazon Prime, what you get is that not only the media content, you can go and see movies and those serials, you also get free delivery of some of the items which you order, right? You also get a preference amongst others for those sales and whatever happens. So before Ind AS 115 was a new revenue standard, they were allocating that 999 rupees into what is the media content, the subscription part of it, what goes to the free delivery part of it, or the other benefits which the user is getting. Post 115, what they concluded is that all those are not relevant, right? Because what I am getting is for the media content, and day one they amortize over the period of, they stop allocating there. Because the obligation is not there, by default there, right? And it was a simple straight line over the period of 12 months, 999 every month, whatever 75 or 80 rupees come, that is straight line. Right? So when you look to the fine print of it, you will see that yes, from optics it may look like nothing has changed, but when you see the scenario, you will see innovative contracts being entered today with all these new kind of startups, with MNCs, the typical barter transaction which has been prevalent for long is with something like Times of India. What it does is that to promote your brand, to promote your company, it will always dedicate a half page to you. Right? And in turn they get equity shares of the company, maybe 2% or 5%. This is a typical barter transaction which is ongoing for years now. Right? And what has happened is the guidance is more specific now, more clear, and it's still evolving, still interpretation issues are there. Obviously revenue has always been a debatable topic for so many years. Right, sorry, I think.
Yeah. Yeah, so any questions so far? So, and just before I move on to the other standard, one quick this one. So, given that in some sector there is going to be a significant change as a result of application of this standard, so typically this is a change in accounting policy. Right? So, previously there was an accounting policy that was defined under Ind AS 18. Now there is going to be an accounting policy defined under Ind AS 115. When you change an accounting policy under Ind AS, you have to do it retrospectively, which means that you have to apply that accounting policy as if it was always applied, even your past financial statements. Okay? But given that this is a significant change to the standard, there is a specific transition methodology that they've given, which allows you to not apply it for your past transactions. It's a choice. You can continue, if you choose to go back and apply it for all of your previous transactions also. Or there is a choice that has been given called the cumulative approach, which allows you to not change your comparative financial statements, leave the past transactions as is, and only for your current open transactions you will apply the standard. So only from 1st April 18 the standard will be applied. For all transactions that occurred before 1st April 18, you would have applied Ind AS 18, and that is absolutely fine.
No, there's ever disclosure also not.
No, there is a disclosure that is required in terms of a couple of disclosures. One is what transition method you adopted. Second is, if you choose this transition method, technically your financial statements are no longer comparable, right? Because 1 year is on one standard, the other year is on another standard. So then you have to make a disclosure saying in the current year, if you had applied the old standard, what would your revenue have been? It's the other way around. Instead of saying in the previous year, if I had applied the new standard, what my revenue would have been, which is what you would have done for retrospective. Here, you say in the current year, if I had applied my old standard, what would my revenue have been? So that is the disclosure that you need to make. Okay. Any questions? So the last topic that we'll pick up for the day, and although this particular topic that we're going to talk about is not really sector specific, this is sector agnostic in the sense that it depends on the nature of the transaction. Ind AS 115 revenue is more sector specific because the impact that is there will vary depending on the sector that you are in. Whereas this Ind AS 116 is sector agnostic. It does not matter which sector you are in. If you have these kinds of transactions, it will impact you. So firstly, anybody aware what Ind AS 116 is about? So Ind AS 116 again is based on an IFRS standard called IFRS 16, which is leases. So Ind AS 116 is the new accounting standard that is going to be applicable for leases going forward. Okay. Ind AS 115 we said was applicable from 1st April 2018. Ind AS 116 is expected to be applicable from 1st April 2019, which is next year. Okay, so currently there is an exposure draft which has been issued. The exposure draft has been certified by NACAS, which is the standard setting body, and it is with the MCA for approval. So it is possible that, like it happened with Ind AS 115, the standard may get notified very close to the application date, which is March or February next year. But we are expecting it to be notified because, again, as I said, this is also coming in IFRS, and we want to keep the whole standard setting process wants to keep the differences between IFRS and Ind AS to as little as possible. So what is the difference? What is this new lease standard doing, which was not there in the earlier standard? So if you look at the current accounting for leases, how do you currently account for your leases? As a lessee especially, how do you currently account for your leases?
It's operating finance.
Correct. So firstly, you classify whether a lease is an operating lease or a finance lease, and then depending on whether it is an operating lease or finance lease, the accounting will vary. Okay. So if it is an operating lease, you will effectively straight line your lease rental over the lease period. There is no asset, there is no liability that gets recognized. There is only a disclosure in terms of what is your future commitments for these operating leases. If it is a finance lease, what will you do? You will recognize an asset and a corresponding finance lease liability to make those payments. Okay? And the asset is recognized at its present value. And there are some indicators that you follow to say if it is an operating lease or a finance lease. What this standard is doing from a lessee perspective, lessor accounting is unchanged, more or less unchanged from what it was in the previous standard. But from a lessee perspective, it has taken away the distinction between an operating lease and a finance lease. So going forward, there is going to be no concept of an operating lease and a finance lease if you are a lessee in a lease transaction. Okay. So what does that lead to? That means all leases will be accounted for in the same manner, irrespective of whether it was previously classified as an operating lease or a finance lease. And that single model effectively is very similar to your current finance lease model. So even if it is currently an operating lease, once the standard comes in, or for all leases, you will recognize an asset on your balance sheet and you will recognize a liability to make payments. So for example, if you are renting this building for a 5-year period and the useful life of this building was 60 years, you would say that this lease is an operating lease. Okay? 5 years over 60 years, it will tend to be an operating lease. Under the old standard, you would have had no asset or liability on your books. Under the new standard, you will have to recognize the right to use the building for 5 years as an asset on your books and a corresponding liability to make payment. Okay. So what was essentially, because what the standard is trying to do is effectively get more than the asset, it is trying to get the liability on your books. So there is a commitment to make a payment, right, over a 5-year period. Even if it is an operating lease, like in the case of a building, there is a commitment to make a payment over a 5-year period. What was happening in an operating lease scenario was that commitment was off balance sheet. It never was reflected on your balance sheet, it was off your balance sheet and was only shown as a disclosure. What this standard is doing is bringing it on your balance sheet.
What about the existence of a contingency? There may be some other terms in the lease agreement saying that I have notice period, I can ask you to go in 3 months. So you assume that that is not likely to happen.
Correct. So firstly, you
notice
definitely
period 3 months. So the landlord has got a right anytime to send you, ask for the permission.
So you will have to make some assumptions.
No, what I'm saying is what's expected to be done.
So the standard.
I assume it is not there.
What is not there?
That lease condition is not there.
If it is not there.
No, I mean, you can't do it any other way. There is let us say, standard notice period is there in every agreement.
Correct.
Even if it's a lease agreement. So landlord has the right to ask you to go. Now you are going to create it for 5 years on the assumption that you got liability for 5 years because you said the lease, it's not being reflected.
Right.
So the fact of this right of the landlord is not playing a part.
No, it will. So even
I'm just
today,
asking, I'm just misunderstanding, I just don't know. I'm just asking.
So even today, the concept of a lease term. So even today, the accounting is always done on the basis of what we define as a lease term. And what is a lease term? A lease term is the non-cancellable period. So typically, in a lease, there will be a non-cancellable period where the landlord cannot throw you out, and nor can you vacate the property and not make the lease payment. So non-cancellable period will always be part of the lease term. Plus, on top of the non-cancellable period, there may be further allowances for extension of that lease beyond a period what what it depends on is whether you have a right to make the extension as a lessee, or the extension has to be mutually decided between the landlord and you. If you alone have the right to extend the lease and the landlord does not have any say in it, then you consider those periods also if you reasonably expect to make that extension. If it has to be mutually decided, then you do not consider it as a part of your lease term. So the liability will only be...
In actual practice, most agreements have got this non-cancelable lease term.
Correct.
4-5 years is there.
Correct. So at least for that period, you will have the liability. Obviously, there may be some restrictive conditions that say if you damage the property, the landlord can throw you out. So there you will assume that you will not make those. Yeah. So you have to...
I think that's correct. So, see, again, what is important is that, as Shantanu said initially, this is irrespective of any industry and any kind of lease agreement, and it doesn't change anything from the lessor's perspective. Right? It is only lessee. Lessor doesn't change anything. To answer your question on the legal right, whatever legal right he has, he will have that asset in his books. What the standard is saying that if you have a right, you are not creating that asset in your books. So, for example, if you take this building, that building will be in your books as a fixed asset. In my books, what it comes is the right to use this building for that legally agreed period for that non-cancelable.
And it is balance sheet neutral.
Exactly.
It's supposed to be balance sheet neutral.
Exactly.
It
Because
starts off as balance sheet neutral.
Later the depreciation and this
Correct.
difference will come.
Correct. It
but
starts
effectively
off.
it will be zero over the period.
Yeah,
Sorry?
Effectively it will be nullified.
It will be nullified.
But what is the appropriate way to judge the quality of the balance sheet? Is it with this or without this? In a sense, the purpose of all this must have been to present a more fair picture.
Correct.
As per the fair value. Is this fair? Is the question.
Yeah.
So if it is fair, then why is it also fair for the lessor? Means if it is fair for the lessee, how can it be fair for the lessor?
Okay.
I'm just asking. So
Yeah, fair enough.
If you don't have any other questions.
Yeah, fair enough. So let me answer it first from a lessee perspective. Why this change is made? So if we look at the indicators of when it is an operating lease.
As a person who is analyzing the company from its performance perspective, will he consider this
He will.
into his
Yeah, as an
ROI
analyst.
and ROE and so on?
Correct. So as an analyst, typically, so let me just, so if I was looking at the indicator of an operating lease or a finance lease, typically there was no hard rule, as in at what point the lease becomes a finance lease. But you had some kind of thresholds that were identified, which said if the lease term is more, as an example, if the lease term is for more than 75% of the useful life of the asset, it is a finance lease. Now say the useful life of the asset is 4 years. If the lease term is 3 years, it is a finance lease. If the lease term is 2 years, 11 months, we used to say it is an operating lease. Now substantially or fundamentally, there is no real difference between the two. But the accounting is fundamentally different. So now what then happened, and there was a whole industry that decided to use this advantage to structure leases as operating leases for companies to achieve some specific accounting objectives. Over a period of time, what happened was analysts actually understood that this is what was happening, which is why the standard setters then said, okay, you should, if you are accounting for it as an operating lease, you should at least have a disclosure to say what is your future lease commitment. What are the payments that you still have to make on operating leases in the future, although you do not recognize the liability on your balance sheet. And therefore, analysts used to take that data, the disclosure data, and adjust it with your liabilities to say, actually your recorded liabilities is so much, but there is so much of off-balance sheet liabilities that is sitting in the company. So that was the whole background under which this discussion started. So if analysts are anyway looking at financial statements that way, should we not have the liability on balance sheet in the first place? Which is why, from a lessee perspective, the accounting changed. Now coming back to your question on lessors, how is it fair? Actually, when under IFRS, when the initial drafts of the standard had come out, they had tried to mirror the lessee accounting in the lessor books as well. Which they said if you recognize an asset, the lessor should recognize that asset to that extent. But they quickly realized that it is causing a huge amount of pain, more pain for the lessors. So it was more of a practical, I mean the problem was more from a lessee side than the lessor side. It was more of a practical decision to allow lessors to continue accounting as is and for lessees to change because that is what users of financial statement would find good.
So the same financial analysts will also have to recognize that by this inventive accounting, the lessors have a source of revenue more than what is disclosed. Just as the lessee has liability, a source of costs more than what is disclosed, there is also for the lessor a source of revenue not disclosed in the same brackets as. But anyway, I mean, it's
but it was a
cumbersome.
conscious decision taken not to. Any questions on? I mean, I will not go through the details of the standard because obviously that takes a lot of time. But if you have any questions, I'm happy and we'll get around sometimes. So happy to take those questions offline. And just before I end, similar to the revenue standard that we spoke about, where there were two transition choices, which is retrospective and cumulative. Similarly, for leases also, you have a similar choice. So whatever accounting you did previously, you grandfather it, and then you only apply the standard from 1st April 19, when we expect the standard to be applied. So, alright, thank you very much. So that's the last session for the day.
Yeah. Everyone waiting.
No, for example, this lease standard, revenue is more of a, it's difficult because it's not standard. But leases is more standard. So SAP has recently introduced a module which
Generally SAP is a norm.
Yeah. And Oracle also expecting that they will.
We have come to an end of interesting session. I thank Amrish Raj and Abhishek Sharma for excellent presentation. I thank on behalf of Bangalore branch of ICA. May I request our senior member Srinivas sir to present a memento as a token of appreciation and respect.